Now, in order to control the reserve borrowing and lending in the Fed funds market and therefore administer the Fed funds rate, the Federal Reserve Bank would track certain indicators called the net free reserves and net borrowed reserves. So let's try and understand these reserve indicators. Now we know that the total reserves equals to the required reserves plus the excess reserves. Since the Federal Reserve Bank needs to control the demand and supply of reserves in the Fed funds market to administer the Fed funds rate, the Federal Reserve Bank is not concerned with the borrowing through the discount window, since that borrowing does not flow through the Fed funds market. Subtracting the discount window borrowings from the total reserves demanded, the Federal Reserve Bank would get the net reserves. The net reserves is equal to the required reserves plus the excess reserves minus the discount window borrowing. As we have seen in the section on how banks maintain their reserve requirements, that banks' required reserves are maintained based on an average deposit size. For simplicity's sake, let's assume that the bank's back office, after taking into account typical deposits, withdrawals, high value clearing, etc., estimates the average deposits to be $100 million over the computational period. If the reserve requirement is 10%, then the bank would maintain 10% of $100 million in required reserves. If the economy consists of 1,000 banks or eligible institutions, the required reserves would be known by all the banks in advance at $10 billion. Depending on the deviation between the estimated deposits and the actual deposit size that banks would know only on day 13th of the 14-day maintenance period, the two variables that fluctuate are excess reserve borrowing or lending and the discount window borrowings. Banks with excess reserves will lend to banks still required to maintain their reserve balance. This difference is known as net free reserves. If the difference is positive, which is that the excess reserves are greater than the borrowing requirement, then the reserves are called net free reserves. Net borrowed reserves are when the borrowings are greater than the excess reserves. Obviously, net free and net borrowed reserves are essentially the same except for the sign. So therefore, required reserves fluctuate depending on the deposit size. However, the net free reserves, which is nothing but excess reserves minus the discount window borrowings, generally remain constant period over period unless there are any policy changes by the Fed. As borrowings fall, the Federal Reserve Bank can prop up the Fed funds rate by inducing borrowing through its open market operations through the sale or repos of securities. As the Fed drains liquidity from the market, the net free reserves shifts from positive to zero to the net borrowed reserve position. The higher the net borrowers of reserves, the tighter the policy, and the more pressure on the Fed funds rate till this rate hits the discount rate. At this point, eligible institutions will start borrowing from the discount window. The two most important measures of the Fed's monetary policy are the net reserves position and the discount window borrowings. Now let's assume that the total reserves breakup of $20 billion equals to the required reserve plus the excess reserve, which is 18,500 plus the 1,500 in excess reserves. If the discount window borrowing is 500 million, then the amount that is not borrowed from the discount window, which is the non-borrowed reserves, equals to the total reserves minus borrowings from the discount window. So that is total reserves minus the discount window borrowing, but if you substitute for total reserves, you get the required rate of required reserves plus the excess reserves minus the discount window borrowing, which is equal to 18,500 plus 1,500 minus 500. So this ER minus DWB is the net free reserves. The net free reserves is therefore $1 billion or 1,000 million, of which the excess reserves is $1,500 million and the discount window borrowing is $500 million. Therefore, the net free reserves is equal to $1,000 million. Now, net borrowed reserves, as we've said, is when excess reserve is less than the discount window borrowing. That is, banks are borrowing from the discount window to borrow their reserve requirements. Since required reserves are just what they are called, which is required, judging from the increases and decreases in the net free reserves, we can see that if the net free reserves drops, it implies that the Federal Reserve Bank is tightening its monetary policy. So an example would be that the net free reserve drops to $800 million. This is because when the Fed tightens its monetary policy, the borrowings from the discount window increase. So the NFR equals 1,500 minus 700 equals to 800 million. If the Fed tightens further and the Fed fund rate rises above the discount borrowing rate, then the borrowers will shift their borrowing to the discount window. So the NFR becomes the NBR, or the net borrowed reserves. And therefore, net borrowed reserves would be 1,500 minus 2,000 equal to minus 500. Therefore, banks are borrowing their excess reserves plus a portion of their required reserves from the discount window. Now, it would also be useful to know if there is a relationship between net free reserves or net borrowed reserves and the Fed funds rate. Now, however, in 2013, this series of calculations by the Fed on the net free reserves and net borrowed reserves has been discontinued. Since in 2012, changes in the reserve administration by banks has been simplified. Now, the costs and the complications of reserve administration by depository institutions such as banks was a good reason for the Fed to modify its Regulation D. The regulation was simplified to create a common 2-week maintenance period for all depository institutions and a penalty-free band around reserve requirements. So the primary focus of the Federal Reserve Bank is now to influence the behavior of households and firms borrowing and lending by influencing the Fed funds rate, and in turn, short-term and long-term interest rates. A decrease in interest rate causes an increase in loans, an increase in checking deposits, and an increase in the supply of money. An increase in interest rate causes a decrease in loans, a decrease in checking deposits, and a decrease in the supply of money. So the new changes in policy as a result of the 2008 recession, the Federal Reserve Bank lowered its Fed fund rate target range to near 0%. In addition to its regular open market purchases, it began buying very large amounts of government securities to influence longer-term interest rates. Since interest rates are priced off the risk-free rate being the rate on government securities plus a risk premium plus an inflation premium, the reduction of the risk-free rate would bring about a reduction of nominal interest rates unless the risk premium increases, which it usually does in a recession. So the inflation premium also needed to be addressed by the Federal Reserve's easing program. The Federal Reserve Bank also started paying interest on deposits at the Fed. In the past, the Fed was very discreet about its monetary policy intentions. However, post the 2008 recession, the Fed increased its transparency on its assessment of economic outlook and its intentions regarding the federal funds rate. So in 2014, the Fed made announcements about its plan to start normalizing the monetary policy. And in December 2015, the FOMC decided to raise its federal funds target range. So far, we've mentioned that banks borrowing and lending causes disturbances in the demand and supply for Fed funds in the Fed funds market, and therefore changes in the Fed funds rate. However, there are other factors that cause fluctuations in the reserve position that the Federal Reserve Bank needs to address through its defensive open market operations. So we will discuss those other factors next, since the Federal Reserve Bank needs to make adjustments to the amount of reserves it needs to control in order to influence the Fed funds rate.